Hello, everyone. We have a few minutes, I think till 12:15, to give a little expose on the microfinance sector and if there's any lessons for that for Australia. We've lost a few people in the last few minutes, but anybody know anything about microfinance or familiar with sort of the model, what it is not? In a sentence, microfinance is basically financial services. So formal financial services, loans, savings, insurance for low income or very poor people, particularly in developing countries where the formal financial system or the banking system is not accessible. I ran an organization from 2003 to 2008 that was a significant investor. We raised $60 million here in Australia, and we invested in 18 finance businesses or non-bank finance companies or NGOs. We had every legal structure you can imagine that then turned around and they leveraged that money up and turned that into a loan portfolio of about 2.5 million entrepreneurs. And over the 5-year period, we made loans to about 4.5 million, predominantly women. Why women? Women are just more creditworthy. Men do weird things when they're get money. But I wanted to just sort of today in microfinance, if I go back over the last 15 years, it is a scale. I'm going to kind of tackle a few of the scale questions and scale issue because 15 years ago there was 8 million people that had access to a loan in a developing country, and there was about $2.5 billion lent out. 15 years forward, that number has gone from 8 million to 200 million, and there's 70 billion. In the next 5 years, that will more than double again, and we should cross the 500 million actual outstanding loans, and it'll be about 175 billion lent out in $100, $200, $300, between $100 and about $1,000. So I just want to take you through the three quick little history of 25 years of microfinance in a handful of sentences, and then make some observations about that if that's all right. So
You don't need to be quick. We're going to move it back to 12:30.
we have time. I'll still talk quick so that we can actually have a discussion at the end of it. But there's really been three kind of phases to microfinance. The first 20 years, and led by folks like Mohammed Yunus, from sort of the mid-70s till mid-90s. They were really trying to work out a couple of questions. One, can you lend money to a poor person at $100 and actually get it back? Question one, can I actually get the money? Will they repay the money? Question two is, can I do that, charge interest on that money like most financial institutions would, and can I, at small transaction sizes of $100, $200, make enough interest and actually make the business viable as a business? Second question, without charging too much. Now, for anybody who's traveled in a developing country and asked the following question, do you have access to capital? Most countries, you do have access to capital, even the very low income. The challenge is not access to capital, it's actually the cost of the access to capital. You can pay 300%, 400%, 500% a year. I remember one of the more profound sort of client meetings I was at. We backed a microfinance institution in Delhi that had a lot of Bihari women, which, if you know anything about India, Bihar is a very poor state. And we sat, and 20 women received their loan disbursement. And it was a simple question, what are you going to do with the money? And they were each getting about $150. About 12 of those women, because it was one of the most profound days, said, I'm paying off a debt. And I thought, that's not really productive money. And I said, tell me a bit about the debt. And she said, my great-grandmother borrowed $50. And my mother was mortgaged in the womb. The debt transferred. I picked up that debt. And so the first $50 is going to pay off a debt that I've been paying $200 of interest a year on for 70 years. She said, now, the other $70 I'm getting, I'm starting a business. And I thought, what a profound, you've got debt being erased for generations, and a wonderful opportunity. She said, now I actually have a choice on what I'm going to do. So the first phase of microfinance was really trying to work out these basic questions. Can we lend money? What's it for? You know, it was real enterprise focus. We want people doing productive activities that make them an income. We want them climbing out of poverty. And really, we're getting a basic model together. And kind of in 1997, you had sort of a number of institutions, hundreds, operating in Africa, across Asia, that were making these loans. Then the industry got together in a summit in 1997 and said, you know what, there's pretty much about 1 billion people who can start a business in the informal sector, and we're making 8 million. We're 0.8%, or we need to scale this up. And we said in 10 years, the sector said, we want to have 100 million people with access to financial services. And so the sector went on this massive growth phase, and the business model was very, very simple. One product, a loan. Whether you wanted $500 or $50, you were getting 100. When you got to the end of paying that off and you grouped together 20 women, they cross-guaranteed. So if one defaulted, everybody else paid. If somebody wanted more, they didn't get it. And that model, very, very simple business model that was so straightforward, replicated to thousands and thousands and thousands of branches. But something happened over the 10 years. One, we got to 100 million. But something happened, is we kind of lost sight, and I'll say not everybody, but we lost sight of the client. Because you got a pretty standard business model. You got scale now, but you go, if I need $500 to scale my business, and not everybody's an entrepreneur, some should be working for other entrepreneurs, and we were lending money, $100 to everybody. Some people are burying in debt, and you'd get up to $200, $300, the whole group. And we had no flexibility in this operating model. And then you had from 1997 to 2007, you started to see at the tail end of that, you started to see businesses start to address that question and go, you know what? We think we have one monolithic client that looks the same in every country, everywhere. We've got scale, but how do we now begin to deal with the uniqueness of these clients? And some clients are now really in debt. They got $400 and they just can't pay it. Others should have $5,000 and be employing 100 people. And so the microfinance business model went through a complete and total overhaul where you started to free up this cross guarantee. You started to issue and say, hey, you're more credit worthy, you have more of a capacity to start a business, you shouldn't be in business. And it started to work through the lending products, but then we started to develop insurance products. And so, insurance is a basic need. 13% of Australian GDP goes into the insurance industry paying premiums. In most developing countries, there isn't an insurance industry, and if you have a family member pass away, custom normally means you'll spend 2 or 3 years of income. So not only do you lose a primary breadwinner in the family, you're going to bury yourself in debt. And so a simple insurance, life insurance products. Then we got into weather index crop insurance, and we got all kind of health insurance, and products were started to be invented. And then payments came. So people were transferring money. They live in Delhi, they're working, their family's back in the States, in a rural area, they want to get money home. Well, the mobile phone was a wonderful creation, and you started to see all of this innovation that put the client back in the front of this. And you started to see the business model start to get really, really complex. Along this journey, and I'll just make a comment because we've talked about this in investment, there's some people are interested in the money. How does $70 billion get funded of a current portfolio today? If you look at that first phase, there was the governments, particularly the US, UK, and some European governments, wrote the check for the first 3 or 4 billion. They said, we're going to grant the money to prove this initial model. Basically, for the last 20 years, of the 70 billion, there's very little grants now going in. The second phase of it was people learned to borrow money, so wholesale money, so banks would start to lend. They would take client deposits. So you have it's like all of us. We have a bit of cash in the bank. You might borrow for your mortgage, but you got cash sitting in the bank. The poor are the same, or the low income are very similar. And so we started to develop institutions that took deposits in a local area. Average deposit's $100, $200, but you can fund the portfolio off of that. And so now today, you've just in the last 4 or 5 years, you've seen equity, really formal equity going into these institutions, and people saying, hey, I'll commercially invest. But commercial money has been in the sector for 20 years, both from I'm paying for deposits or I'm paying for a loan. And so it's really interesting to see, and I want to make sort of 3 kind of observations, because about 5 years, 7 years ago, it got really interesting because the industry hit scale. We had 30 billion in the market, and all of a sudden you started to get technology companies joining. The mobile phone companies said, hey, this is an opportunity. We should start develop payments. We started to get the global banks saying, hey, we want to lend money. In India alone, which we had a fairly large business there, the Indian banks, there's $4.5 billion in the microfinance sector today. Indian banks have funded 4 billion of it. They lend money to the microfinance institutions and lend back. But until it hit scale, some degree of scale, the banks just said, you know what, I'm not doing the credit. This is too risky, it's too small, the sector's uninteresting, and I gotta hire a whole team, and I'm just not willing to do it. And so the sector as a whole got really interesting for a lot of people, and it started to attract people that weren't necessarily development professionals, but bankers who said, you know what, there's a business here, and there's a market need that is quite significant. The second kind of point, which I alluded to, was during this growth, and I think when we went from customer focus or the client, or right at the beginning, it was the total reason, you know, Mohammed Yunus sort of went out, he said, I'm really working these. As soon as investors came in, and regulators came in, and lenders came in, and partners came in, and the scale started to go, we went off that. But then you see these phases where the industry has come back to the clients. And so one is, I think any lesson in any scale, keeping, and the real leaders, Grameen Bank and others, kept the client at the front of that. Third point, and we mentioned, this was mentioned in the last session, is the ecosystem around it, just the financial intermediaries. So this is people who source. So I'm an investor sitting in the US, I have $100 million I want to spend, I'm a pension fund, I want to put it in a microfinance fund. There are 100 funds that manage 7 billion. There are another 4,000 to 5,000 advisors that play everything from, you know, consulting roles, financial advisory, capacity building, and those would be organizations that then have staff on top of that. And so there's an entire now sophisticated, and some just deal with aspects. So currency, you know, these funds invest in many currencies. There are institutions that just manage the currency risk. That's how specialist the ecosystem has become. Fourth observation, and I think this is one that scale kind of brought out and commercial money brought out, was motive. Soon as you start to get scale and start to attract, I think Doreen was mentioning too, you know, SKS in India floated itself on the Mumbai Stock Exchange and had a market cap of $1 billion. The founder of it cashed out for about 60 million on the back of poor women. Now, there was, for 3 years before that, private equity firms seeking 30, 40, 50, 100% returns were piling into that. One extreme, a profit maximizing on the back of disadvantaged, marginalized people. At the other end, you had social investment funds that were investing. And one of the things that, you know, we need to be clear as funders, as social enterprises, as investors, we need to understand motive. And, you know, we were talking about investor ready, and Doreen was mentioning this last night in a talk, and we sat with an investor. We were a social investor, and I'll just highlight this. I mentioned this in a session yesterday, and I had an MFI. We were meeting with them for the day, and they said, we want a really commercial investor, and we've got one identified that wants a 30% return, and we want you as a social investor. You know, you want a smaller return, but you're going to keep us honest on our mission. And I said, you know what? We're going to actually have a terrible conflict. And I said, I don't see us as complementary. And they said, why? And I said, we're both going to hammer you to be efficient and develop good products and be high performing as an organization. But I said, we're only going to debate at one level. So I'm going to join him in his cause to make you really efficient. Because I want the poor to have, you to have a large organization that has scale. We want lots of people to get access to capital. But I said, we're going to have one debate. Is he wants 20% because he has to pay 20% to his investor. And so when it comes down to the dividend choice, when you have to pay the investor, you know what I'm going to say? I'm going to say lower the interest rate from 12 to 10. Develop a new product for a lower income or a more marginalized group. Or adapt this product or double the service because we know that community is suffering because of. And you're going to do commercial things because there's a dividend. And I said, we're not going to debate the performance. We're going to push you to make you the best organization. But we are going to debate who gets what and what's the relativity of that. And so motive becomes a very important discussion, particularly as a sector starts to attract large amounts of capital. And we kind of developed quite a sophisticated, and I'm looking at Callum did one part, but we did a fairly sophisticated screen on how we decided whether somebody was socially sort of focused. One was who they were focused on, and we learned to sort of say, is this the community or income levels? And we had a series of tests. Two, what they were offering and the pricing, whether they would protect the customer. Will I over-indebt a customer? Will I just keep layering debt because I make more money? And the third is who was else sitting at the table as an investor. I'm only going to make one last comment about the future of microfinance because I think it's turning again. You have some very, very significant global corporates and technology companies and partners now entering and participating in a really significant way. I think it's an absolutely wonder development. I'll give you one. I worked extensively with BSP, the Bank of South Pacific in Papua New Guinea. Papua New Guinea is it's a really hard market to do microfinance because there's a fair amount of violence and people don't trust each other, and it's very dispersed across lots of islands. BSP with a simple tablet, a simple technology, signed up 500,000. They had 500,000 clients for the first 30 years of existence. In the last 18 months, signed up 500,000 people with a mobile phone and a tablet. Payments from mining companies, loans, transfers are going all around PNG because the bank, not a microfinance, not a social enterprise, the bank said, we can do this, and we can do it at scale for a country. You're seeing that kind of development. But it's not without its challenges. And I think, like I said, it's coming back to some of these observations and how they relate as we begin to scale. I'm happy to have
Just some questions.
questions?
And then